All right, hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our options trade of the week. We're going to start out by taking a look at our trade from last week on Apple. We ended up closing it out for a really nice profit here this week. I know a handful of you took the trade here from last week, so I want to review it, walk you through how we ended up managing the trade, and then we'll also take a look at a brand new trade coming up for next week on SPY. Let's start out by taking a look at the 130-minute chart of Apple. This is the chart that we talked about in the last video. If you have not had a chance to look at that video, go back and review it from last week, and then make sure you hit the subscribe button on the channel here in YouTube. That way you're notified anytime that we do post an update, do post a video. We are posting these trades of the week on a regular basis, so we don't want you to miss out on any of these trades that we do send out. So looking at the 130-minute chart, we like to use our pulse indicator. That's the indicator down at the bottom. It's our red and yellow histogram. And we talked in that video last week about how this indicator was plotting yellow. What that means is price is between a 1 and a 2 standard deviation move on the downside. In other words, we're oversold. When you start to see a 1 standard deviation move like this, it doesn't mean the stock can't move lower. It just means it's not statistically probable. Only 13.6% of all occurrences fall outside of this range. When I see this type of a reading, it has me interested in putting on a trade that would benefit from the stock stabilizing or even reversing in the other direction. Well, we came in and we sold a put spread to take advantage of the higher volatility. The options have been incredibly expensive the last couple of weeks due to volatility being so high. So we sold a spread, we sold a credit spread to take advantage of that. Selling a put spread is a neutral to bullish trade, and we were ideally looking for Apple to bounce. Now, I was not expecting it to bounce off of 150 and go all the way up to 163 within a couple of days. It's been a phenomenal bounce here this week, but it happened. So it worked out in our favor pretty quickly in this case. Let me just jump over to the trade page and we'll show you the details of that trade. We talked about using the March 25th weekly options. Those are the ones that have 7 days left to expiration. And we sold the 150, 148 put spread. We were selling the 150 put, buying the 148 put at the same time. We ended up collecting 50 cents on this trade. We collected $50 per spread. It only tied up $150 of our capital. That was our worst case scenario. We were going to lose 150 bucks if we were wrong on this trade. So it was very reasonable regardless of account size. Fortunately for us, put the trade on expecting Apple to bounce, and that's exactly what happened. It is now trading for 6 cents here mid price. You're looking at the saying, if it got cheaper, how do we make money? We sold the spread to open up the position last week. The ideal scenario is for us to buy it back cheaper and we pocket the difference. In this case, if you were to sell out of the trade right now, you're looking at about a $44 profit per spread. Pretty nice return considering we only tied up $150 to begin with. You put it on with 10 contracts or 10 spreads, you're talking about $1,500 of risk, and now all of a sudden you've got $400 of profit in less than a week on one trade. Pretty nice outcome, right? This is why I love these types of strategies. We all get attracted to trading options because we love the big profit potential, and buying long calls and long puts can certainly provide that, but it's also pretty aggressive. I love to take what the market's giving us, and when volatility gets high, I would much rather take a more forgiving trade like this credit spread because now we're able to stack the deck in our favor. We gave ourselves 5 ways of making money on this Apple trade, and that really helped produce a quick profit for us this week. So that trade has been completed. Why didn't I continue to hold for another 7 days? If it continues to move higher, I get to book the entire profit and not have to pay a commission to close out of the trade. Well, I only have 6 cents of additional profit potential here. I still have the full risk on the trade. The risk reward doesn't match up at this point. I'd rather take the profit, free up the capital for my next trade. And also, if you're using TastyWorks for your broker, they don't charge a closing commission anyway. So you're not saving anything on the commission side by holding into next week into expiration. That's why I prefer to close out of the positions early, take the partial profit, and move on to the next trade, which is what we're going to do over the next few minutes. So nice trade there on Apple. We are now going to transition into our next new trade for this coming week. And when I structure this trade, I'm actually going to use TastyWorks for the example. I had some requests from a few of you that wanted to see the trade placed in TastyWorks, so I can certainly do that, and I'll show that to you here today. Just looking at the market big picture, the last 4 days, I mean, it's just been another phenomenal rally. I mean, the market looked incredibly weak coming into this week, and the news cycle had been very negative with the Russia-Ukraine conflict, energy prices skyrocketing. You've had inflation numbers lately just out of control. All of that was weighing heavily on stocks coming into this week. Markets hate uncertainty, but we did start to see a little bit of clarity this week. The Fed ended up raising rates. raised interest rates by a quarter point. That was expected. That's exactly what happened. Markets now have a little bit more clarity that the Fed is indeed going to try to fight inflation. Now, the argument could be made whether a quarter point's going to do anything, but they at least got the ball rolling here. And as a result, we have seen this impressive 4-day rally off of that low right around just below 416. We are now sitting just below 442. That's a phenomenal rally on SPY, especially given that the news cycle is still very, very active here. But we are heading into some key areas of resistance. We've got the 50-period moving average sitting right here, right around 442. That's going to be a key area of resistance going into next week. After this 4-day rally, could very well see a pause. I'm not expecting the market to fall apart. Obviously, the wild card there would be any type of escalation with the Russia-Ukraine conflict going into next week. We'll see if that ends up happening or not. But I fully expect at least a pause over the next few days. Right now, could I come in and buy a long put just expecting the market to sell off next week? I could, but it's too aggressive. I'm not that confident that the market is going to make a big move next week. I just think it's going to pause and potentially get a nice healthy pullback for a few days. So how do I play it? The volume continues to be great. I mean, we've had 100 million shares trade on a regular basis here the last number of weeks on SPY. It's great. That's pretty good liquidity. The ATR remains active. We have an ATR on the daily chart above 9, indicating very, very active markets on a daily basis. And then the VIX, even though the VIX has contracted significantly here this week from around 30 down to 24.5 currently, the volatility is still elevated. The volatility that's being used to price the options, meaning the options are more expensive right now. If you're going to buy an option, you're going to pay up for it. And you really need a bigger directional move for that trade to work out in your favor. I would rather stack the deck in our favor, take advantage of the high volatility by selling a credit spread, just like we did last week on Apple. So we're going to take a look at the S&P 500 ETF. We're going to take a look at SPY. We're going to start out by taking a look at the 130-minute chart, but we're also going to take a quick peek at the 60-minute chart as well. So on the 130-minute chart, you can take a look down at our pulse indicator. That's the one that we were just talking about a few moments ago on Apple. We have the last 5 bars plotting yellow. Now we're at an overbought condition. We're at between a 1 and a 2 standard deviation move on the upside. Doesn't mean SPY can't head higher next week. It's absolutely possible. It's just not probable because now I know that only 13.6% of all occurrences fall outside of this range on the upside. When I start to see an overbought condition like this, my expectation is that we're going to see a period of consolidation or a reversal in the other direction. If I take a look, just take a look at the most recent action here on the screen on the pulse. We had all these yellow, green, blue bars on the downside. What happened? Price stabilized. We saw a nice bounce higher. We then got another oversold condition right here. We had this whole slew of yellow bars here again. What happened? Price moved to the upside. It's a very repeatable pattern. Markets hit extremes, price stabilizes, and then reverses in the other direction. In this case, now we flipped it around. Now we have an overbought condition. We would expect going into next week, and at least an attempt at markets starting to chop sideways or even reverse to the downside. Now, if I go over to the 60-minute chart, to the hourly chart, it's even more significant because now we have green bars on the upside. When I see green bars on the pulse, that indicates that price is between a 2 and a 3 standard deviation move. Now we're even more overbought. This has me interested in a very short duration trade. Am I saying the top is in and we're going to head lower for the next 2-3 months? No. The expectation on this trade is going into next week. If we can get a 2 to 5 day pullback, that's something that I'd be interested in taking part in. All right. So instead of buying a long put, we're going to come in and we're going to take a look at selling an out of the money call spread. Instead of showing it to you in Thinkorswim here today, I'm going to go over to TastyWorks and let's go to the trade page. You're looking at the SPY trade page. We have to decide what expiration cycle we want to go with. Could I go all the way out to the April monthly options? Well, I could. They have 27 days left to expiration. The problem is that doesn't match up with my expectation for the trade. If I was expecting SPY to move lower for the next few weeks, then I certainly could get away with April. But remember, I'm looking for a pullback over the next 2 to 5 days. I want to use an expiration cycle that would allow me to make money from a quick pullback, even if it only lasts a couple days. So instead of using the April monthlies, I'm going to go ahead and we're going to open up the April 1st options here. Those are the ones with 14 days left. With 14 days left, the nice part about that, the time decay is more significant. Anytime you get less than 20 days to expiration, the theta, or the time decay, becomes way more significant, meaning those options are going to lose more value every day that passes. That's a good thing for us using a credit spread. We want the options to get cheaper. These options are more sensitive to changes in stock price because they only have 14 days left. It's called the gamma. The gamma is more significant, meaning the options are going to react faster to changes in stock price. I also want that because I'm looking for a very short duration trade. All right, so we're looking at the April 1st weekly options with 14 days left to expiration. My starting point, anytime that I come over to the trade page and I'm looking to sell a credit spread, I want to go to the option that has around a 65% chance of closing out of the money. You can see that 65% number right there. It's the 448 call. I'm going to left click on the 448 call. As I left click on the bid price of the 448 call, it boxes it in red, indicating a sell order. I'm also going to left click on the ask price of the 450 call. That's going to box it in green, indicating a buy order. When I trade a spread, all I'm doing is trading two options at the same time in the same expiration cycle. I'm selling one option, in this case, the 448 that's closer to the stock price, and then I'm going further out of the money to buy the 450 call. This puts on a risk-defined trade. I know what my maximum loss is right up front. And the ideal scenario is I want to collect right around 50 cents on this trade. I want to put on a spread where I can risk between 2 and 3 to make 1. If I trade a $2 spread and collect 50 cents, I would be risking 150 to make 50. I'd be right around risk 3 to make 1. Well, the spread down at the bottom that I have loaded up is trading for 82 cents mid-price, well above the 50-cent number that I'm looking for. So if I'm looking at a higher number here, that's more profit potential. Isn't that a good thing? It could be, but I would rather move my strikes. I can adjust my strike prices here and try to get as far out of the money as possible. The further out of the money I get, the more buffer I have, the more wiggle room I have for this stock to move against me and still be okay. In this market, we've seen so many big directional moves. I want to have more of a safety net just in case I'm wrong directionally. So let's go ahead and adjust the strikes. And all we have to do inside of TastyWorks to do that is I can left click on the options here and I can drag them up and down. So let me left click on the 450. Let's go to the 454 and I'm going to move the 448 to 452. See what that gives us. Now I'm looking at a spread that's trading for 61 cents. Remember, I want to get a spread on that gives me right around a 50-cent credit. So let's move it one more time. Let's move them down to 456 and 454. Now it puts me right on top of 50 cents mid-price. That's great. That's the number I'm looking for. In this case, I'd be selling the 454 call, buying the 456 call. Now, if I get filled at 50 cents, you can see I'm risking 150. That's my max loss. And the only way I take that max loss in the trade is if I hold all the way up to expiration and the stock moves against me the whole time. I can always close it out early and take a partial loss if I need to. My max profit is 50 bucks. Okay. So everything matches up with this trade. It matches up with my outlook. Now, if I go back to the trade page, I need to decide what type of quantity I want to use. Right now I have it set to 1. I'm going to change the quantity. Let's just go ahead and I'll just use 10 here. Okay. So if I take it with 10 spreads, I'm risking right around $1,500 to make 500. The reason I'm okay with that is I have 5 ways of making money on the position. I make money if the stock moves up, down, or sideways as long as price stays below 454. That's the strike of the option that I'm selling. I also make money from time decay adding up and from volatility decreasing. I've got 5 ways that I can follow to make money on the trade. It's much more forgiving versus just buying a long put and hoping that the stock moves lower. In this case, if we just kind of chop sideways, I can still work with that. So while I'm talking here, you can kind of see price bouncing back and forth. I'm going to go ahead and place the order. I'm going to adjust my order to 50 cents. And I'm going to go ahead and click on review and send. I'm going to send the order. So now the order is working at 50 cents. Now, just because I place it at 50 cents does not guarantee I can get filled there, right? In order for me to get filled at 50 cents, I would need SPY to move a little bit higher. Okay. So, I can either wait to see if SPY moves higher, but what if your schedule doesn't allow that? There's a couple things that I could do. I could go back to my working order. Okay, and let me do that. I can go ahead and click on the activity tab and you'll see my working order here. It's now trading for 47 cents. I can either right click on this and go to replace order. That's going to take me back to the trade page and I can change the price from 50 cents to 48 cents. But now if I start to collect less than 50 cents, now I'm risking more than I want. I'm risking more than 3 to make 1. I want to be right around 50 cents. The other option on this would be to cancel the order altogether. Let's go ahead and take a look at adjusting my strike prices a bit. Okay, so I'm going to go ahead and cancel the order and I'm going to come back and let's take a look at the 453, 455. All I did is I moved my strikes from the 454, 456 to 453, 455. I just moved them one strike price closer to the current stock price. Now it bumps me up to 53 cents. I'm right back around that number that I want to be at. So let me change my quantity to 10 here again. And let's go ahead and get the order placed. Go back over to the activity tab. You can see my order is placed at 53 cents. That's exactly where the spread is trading, but I'm just not getting a fill price just yet. Right? So we'll give it a second here. If we don't get filled, I will go ahead and adjust the price. Okay, now let's just say for argument's sake, let's say I get filled at 52 cents. Let's say I make one adjustment on the order and I get filled at 52 cents. Where do I put my target at? What am I going for a profit? The 52 cents would be the most I can make on the trade, but the only way I make that entire 52 cents is if I hold all the way up to expiration. I don't want to do that. I'd rather close it out early if possible. My target zone is between 50 and 75% of the max profit. My max profit is the credit, that 52 cent credit that I theoretically could get filled at. That would allow me to use a target range between 13 and 26 cents. If I can buy the spread back to close it out between 13 and 26 cents, that would give me that nice target that we're looking for. That would happen the fastest if we come into next week and we see any type of selling pressure on SPY. It would allow me to get down towards that target pretty quickly. I've been talking with our members here lately. I've been targeting 50% of max profit. Just given a lot of the false moves that we've had in this market, we've had a lot of headline risk. I prefer to close the trades out early, closer to 50%. That way, I don't get caught by another reversal by holding too long. I'm able to book the profit and move on to the next trade. So in this case, I'm going to take whatever my fill price is. If I can get filled at 52 cents, I would create my closing order, just close the spread out at 26 cents. So let me go ahead. I'm going to go ahead and right click on the order, go to replace order, and I'm going to adjust the price here. So I really want to get filled while we're in the session. So I'm going to go ahead and change it to 52 cents. And there we go. I was filled. So now I've got the position on. So now what do I do? Okay, the trade is on. What I'm not going to do is sit here and watch this thing from opening to closing bell every day. You're going to get so emotionally attached to every little move back and forth. Once you get the trade on, you can get a closing order working and then let it go. Let it do its thing. Maybe check on it periodically, check on it a couple times a day, but do not sit there and be glued to the screen. You're going to drive yourself nuts by doing that, and I say that from experience. So let's go over to the positions tab, and let's go to SPY. You can see my SPY position right here. So if I go ahead and click on SPY, now you see my position. I've got 10 spreads on. I'm going to go ahead and click on both of those lines, the 453 and 455 calls. Now they're both highlighted in gray. I'm going to right click on one of those and go to close position. I'm going to select full position. It's going to take me back to the trade page, and I'm going to create a closing order down here. I'm going to change this to 26 cents, just like we talked about. I'm going to try to get filled right around 50% of our max profit. This does need to be set to a net debit. I am going to buy the spread back to close out of the position. Now, the TIF box over here on the right-hand side, TIF stands for time in force. Right now, it's set to a day order. If I were to keep this as a day order, if my order's not filled at 26 cents come end of the day, that order's going to cancel. I want to change that. I'm going to change it to a GTC or a good till cancel. That way, this order is going to remain in place going into next week until the order gets filled or until I manually come in and cancel it. So now if I create the closing order, which I'm going to do right now, now I go back to my activity tab and you're going to see I have a working order at 26 cents. Anytime over the next 14 days, if this spread is trading for 26 cents, you can potentially get filled, close out of the trade, and book the profit. So now it takes a lot of the stress, a lot of the time commitment out of the equation. I don't have to sit there and worry about babysitting the trade. I've got an order in place ready to go. So we're going to take a look at this. I'll jump back on next week and we'll keep track of it, let you know what we end up doing with it. If you have any questions on this trade, if you end up taking it, if you have any questions on how to manage it, when to manage it, feel free to email me directly, mike@netpicks.com, or you can just comment on the video below. I'm more than willing to respond and help out there. So again, if you have not subscribed to our channel yet, make sure you do so. We're going to be posting videos here next week on a variety of different topics, so we'd love to have you follow along with our channel and like the video as well if you found it useful. So I'm going to wrap this video up here. Again, SPY going into next week, neutral to bearish trade, selling and out of the money call spread. That is our options trade of the week. So appreciate you taking the time to watch the video, and we'll talk to you guys next week.